Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:36 p.m. Thank you for your patience on a absolutely gorgeous New York City evening. Um, this is August 13, 2017. This session will be recorded and uploaded for viewing by all members of Clueless Trading. And I suggest highly that all of them do that prior to trading and markets beginning tomorrow morning. And I think you'll find it extremely helpful. More than helpful, it's going to make you more money. It's really as simple as that. Let's just cut to the chase. Full disclosure, this is purely for financial education, not for any solicitation or advice. And let me just kick in. What you're seeing behind you right now is a live screen of the Globex futures market. This is where we are right now. This is where we were at the bottom on Friday pre-market. This is where the market started, and 2, 3, 4, 5, 6, 7, 8, 9. Just want to make sure. Okay, and this is where we are right now. Futures are up roughly 9 points. That's a pretty hefty move. If it holds, then we shall see some very nice profits on the SPX and the SPY calls that we moderately bought. And the keyword is moderately bought. That's a smart way of doing things. And other positions that we bought on Friday. And that's it. So a couple of broad points that I like to make. We are going through and this is not the first time, so we always act so surprised when the markets pull back that, oh, wow, this is different this time. It's never different. And I'll tell you why. For many, many years, when I worked on Wall Street, I coined the term that I just basically straight out on the face. As you know, I'm a pretty straight shooter when it comes to, saying things. I tell them every crisis in life and in markets and trading is the same for different reasons. Human behavior never changes. It's either flight or fight. It's either panic or euphoria. Very seldom do we find traders and investors who have come to that middle ground where they can handle pressure and when they can basically say, you know what, regardless of what's going on, regardless of whether my P&L's down, got busted out of a bunch of trades because of the time frame, stuff like that, sudden dramatic flash crashes, which we have gone through several times. I've shown it repeatedly. Just in the past month alone, this is probably the third one in the last 2 months. So I find very, very few traders. And I know most of you are trying. I know that to balance your mental, what I call calibration. I certainly try, and I think I'm getting pretty successful at it to become as robotic as possible, and not being swayed by the demons in your head every time that the Dow reverses 100 and well, in this case, it was 190 points to 200 from here to here. Okay, pretty dramatic. North Korea tensions ratcheting up. Friday, to be honest with you, there was no real news. It was just a follow through, and I'll discuss it briefly. I discussed it very much in detail in the advanced coaching sessions over the weekend as to the reasons why. Most of it was actually technical reasons, and plus it was weekly OPEX, all kinds of stuff that needed to be taken care of, i.e. margin sellouts and things like that. So all of a sudden you see a behavioral change in a lot of traders, even within our group, despite my valiant efforts and diligent efforts to calm them. You find a guy saying, that's it, this is it, this is the big one, forget that. They're saying, they never buy stocks. Well, great. I have no problem with that. I'm an independent trader. I'll trade independently regardless of my constant help for others to do the same and prosper. But it's going to blow out a lot of retail traders, okay? We're going to see some people dropping out and stuff like that. And you know what? Good for them. Because it all has to come down to one thing, fight or flight. Now, the way you fight, that's the survival of the fittest. That's just the way things work in life, okay? And especially in capitalism, because we're not socialists and we're not communists. We don't believe that every human ability is created equal. No, we don't. That's not a horrible statement. Every human is created different. Some work harder, some are a little bit smarter, some work harder to become smarter, right? So the bottom line is the weak morsels are going to drop out, guaranteed. And I know exactly who they are, and that's okay. I will try to help them as much as I can because that's my sole responsibility through my technical charts, through my video cast, through my precision alerts, and we will have bad days. And even through these bad days, one of the days which was the roughest was actually Thursday. We bounced back hard on Friday. Hard on Friday. Now, how you manage and your trades and you're lumping in all the money for execution, options execution on that particular Friday, it ain't going to work. You got to roll it out. You got to buy time. What's buying time? Go out another week. Go out another week. I put out suggestions. Remember that keyword, suggestions. I am not God, so I'm not going to tell you, or a prophet, so I'm not going to tell you exactly, like, if this you do this is how it's going to work. I lay out the suggestions. Works for me. Do I get rough days? Absolutely, I get rough days. Do I make back triple that? Absolutely, I do. So Friday was fantastic. There were lots of great reversal trades that were put in place. But you always feel, and I know feel because I understand human beings, I think, better than all of you put together. I mean that. That is from my career on Wall Street, and as a personality, I read people like a book, and it's a good thing. I read myself like a book. I know where my deficiencies are. So the bottom line is, as I go along with this broad statements that I'm making, and as you guys are kind of looking through the charts here, this one I've shown quite a bit, the gap fill and the pattern symmetry. The bottom line is that traders have to be strong, and they have to constantly keep on fighting instead of flighting. It means running. Look, nobody's perfect in the trading business, okay? But some people are better than others in forecasting and showing the roadmap how you need to get there, and you need to know how to get there by using your mental abilities, your grit, okay? That's mental fortitude. The word is grit. And your tactical ability to be flexible. So the key word is, if you don't have the mental grit, which a lot of weak traders don't do, they're going to get flushed out, which is actually great for us because the weaker they are and they fall out, the better off we'll do. Sounds kind of tough. That's life. The weaklings will perish and the strong shall rise. That's the same thing with trading. So don't take it as a negative comment. It's a positive reinforcement. Take your stress, your worries, your losses, and make it into a positive liability instead of a negative liability. Use that towards getting towards where you're going. And guess what? If my forecasts work out, and I'm going to lay it down, this is one opportunity, ladies and gentlemen, where you will most probably make back everything you have lost in a year. And I mean that. And some of the people who have been here, especially one of them here, Corey, for example, who've been with me the longest, at least out of the three that are attending this session, and others who are here, know very well that's the case. Because when we get these type of swing reversal bounces, and I'm not saying that's it, the Thursday lows was the low, okay? And I'll show you what I think based on the pure technicals, keeping all my emotions aside and all your emotions aside for sure. But then you have an opportunity and a window between now and the end of the month, or between now and the end of the week, to make substantial amounts of money. Is it going to be like complete clockwork, where every single thing is going to work in every single time frame that I'm putting through? Nope. Is it going to be where I think the markets are going and whether pattern symmetries will replicate? I think so. Because there's an old saying, charts don't lie. Traders do. They lie to themselves. They lie to others. This is the God honest truth, okay? and then they just screw up big time. And then they blame everybody else other than themselves. So saying all that, these are critical situations on the global markets. We know that. This North Korea thing is not a joke. I think the way the Trump administration is handling it is absolutely perfect. The generals are in control. The Joint Chiefs of Staff issued a statement today saying that they are completely behind the diplomatic and the economic sanctions that are in place, and they would like to avoid a military confrontation. Look, America in the world sphere, and I know world history better than most people out there. We are not colonialists. We don't go around taking over other countries and stealing their wealth. The British did that for hundreds of years. The French did that. The Italians did that. The Spaniards did that. We, as Americans, never have done that. Yes, have we invaded countries for some benefits of ours at times, certain times when they provoked us, or have we, in the 50s and 60s, deposed governments in Latin America for our benefit? Sure. But we have never colonized other peoples, because that is what we are, guys. We want people to replicate the American system because it works better than any other system out there, regardless of all our deficiencies and faults and minor gaps that we have. We self-criticize ourselves better than anybody out there. Trust me, I have traveled the world. I know. So the bottom line is that the North Korean situation is never going to be fully resolved, but it will be minimized. My gut feeling tells me we are not going to get into a nuclear firefight with them. The rhetoric and stuff can be heated up. That's normal stuff. Okay? Will it keep the world markets tense? Absolutely. Our domestic issues that are happening out in Charlottesville and Virginia and stuff will never be fully resolved. There will be people who will have serious differences. Some people are very much on the fringe. That happens in every country. I'm not justifying anything. So bottom line is, despite all that, we will move forward. So the bottom line is that at this point in time, the markets know that. What will derail the markets in a big way overall? Hi, Exita. What will derail the markets in a big way is going to be credit factors in the market, which has to do with Federal Reserve Bank policies, large sudden rate hikes going forward. All of a sudden, we start to get large inflationary numbers. The Fed is forced to raise rates consecutively. Those things will rock the market. But in the meantime, we are going to be trading within a band. It's not going to be one crazy breakout where we're going to go to 25,000 or we're going to crash down to 15,000. Because retail traders like to think that every day there has to be a massive move on the markets. It doesn't work like that. So what it comes down to is that we are in a very volatile market. In fact, it's a heck of a lot more volatile now than it was a few months ago. Now, what do I mean by that? The patterns are the same. But what I mean by that, this, by the way, for people arriving late, is basically the E-minis futures trading right now. Globex futures up 9 points. This is where we closed that on. This is where we closed that on Friday. Here at 16, right there at 4 o'clock, right there, and 3 nice candles hitting the 50 SMA. I'm going to go through all that in a minute. And this is the Fibonacci retracement showing the possibilities of where the markets can bounce to. One thing I do have to add here, but before I get into technicals, let me finish my thing that I'm talking about. There's your downtrend line. Very important, very simple one. And we're approaching that right now. That's at 24.50. Futures are up 9 right now. By the time it hits 24.50 and the downtrend line, which should act as a major resistance, futures are going to be up 11 points. Whoopee, some retail guy is going to look at it and say, whoa, look at futures up 11. We're going to have a huge day tomorrow. No, there are no guarantees whatsoever that the markets are going to hold futures up 11, especially from a technical standpoint. Let me go back to my original thing. when it comes to trading. So retail traders basically are in a state of fight or flight. Either they get completely zonked out of shape, because some tough days happen and sudden flash crashes, which are uncontrollable. Okay, period. That's just the way it goes. They're flash crashes. They're little mini black swan events which are not quantifiable. So what happens with a lot of retail traders, very simply, and is they just lose their head. Fine with me. What can I do? I try to keep people calm. I try to show them that to keep a calm move. Look at selective stocks. This is a stock market. On a day that the markets are up or down, you'll notice there's a whole bunch of stocks, not a whole bunch, but a selected bunch of stocks. And I can't cover all, whatever, 19,000 stocks in the market. But the ones that we look at, I'm showing the ones which are doing extremely well. I'm showing the ones which are doing poorly, which are tactical buys at certain levels, and I'm telling people to stay away from the ones that I think still have room to move down. So the bottom line is that retail traders like to think that everything should move higher because the markets move higher on a certain day. It doesn't work like that. Even within a certain sector, on a biotech sector, let's say having a green day, you will find different stocks which are up, different stocks that are down. You guys know that. So this is where we are right now, by the way. And this is that volatility chart that I've been showing all the way back from June, actually. And that's where it starts off with that. Actually, it starts off here, which was back on June 19th. This is where we are. This is the face of volatility. Ranges, which we can see, but very volatile. So bottom line is that as a retail trader, people ask me, well, what can I do? Well, what you can do most as a human retail trader, regardless of how much capital you're trading with, okay? That's not your excuse. It's not the capital. The capital is never the excuse. When we're showing some severe percentage movers, especially on many multiple fronts, on tactical buys, which can be north of 200, 300, 400%, you don't have to put all your money in that. Well, you can if you want to really gamble, but you don't need a lot of money to put into a trade that goes from 50 cents to $2 or $3. We have shown quite a bit of those. It doesn't take much to buy a Bank of America option at 14 cents. So the excuse about capital doesn't cut it. What you all have to work on, which I work on in my head every single day, is your mental ability to stay calm. Now, that's not going to happen automatically. That will only happen if you truly try to understand the depth of volatility, and the only way you will understand the depth and the power of volatility, which itself, what is volatility? Volatility is designed by algorithmic high-frequency trading machines to make you feel uncomfortable. So face that. Volatility is not supposed to make you feel warm and fuzzy. Volatility is supposed to make you nervous. Volatility is supposed to make you scared. Volatility is supposed to make you almost cry because the trade was going well and within seconds it turns around and goes the other way before you could even react. So volatility is trying to piss you off to do the most stupid things. Now, the only way, in my opinion, that you can harness all those negative emotions and try to keep an even keel is to basically master these tactical charts. Nobody can master them perfectly because each of these candles, when they're happening, either freaked you out or made you feel good. This flash crash that started off on the 8th, which was last week, all of a sudden 8th on Tuesday, right? We were here, we were buying this range, and then bang, it went up. And one of my other charts, I have the line drawn where it hit exactly here and then pulled back. And this was the line. I don't know why it disappeared from here. All I did was I took this and one second. I don't know why it disappeared from here. But it was basically, it hit exactly there. And I am trying to see the level that I had drawn it from. I think I had drawn it from here. I can't remember. but I'll show it to you. I mean, it's there, and anybody who's half focusing on what I'm putting out there knows very well what I'm talking about. And I said that's the point. You got to basically take out most of your profit, and then this very sudden move happened. Bounced up nicely. All the parameters on this move were literally perfect, technically speaking. And then comes Thursday, and the markets decide to completely melt, and the VIX shoots up 44% on this move down. Okay, and all of a sudden, nobody's around, which is fine. Well, remember, when nobody's around with a single, or tactically buying or making any comments and stuff, and the chat room doesn't have to be busy all the time. It can be quiet. That's fine. But it's like pure fear out there, and those are the times to really look at it. So I'm showing different levels where the markets can go to. I'll still show it tonight, and all this type of happens. So bottom line is that the only way that you can basically survive these markets, if you wish to do this, is through truly focusing on the charts. And it's still not going to be easy intraday, but you will get the rewards if you understand where the charts can bounce to, where they can fall to, and all that kind of good stuff. So that's all I got to say. I don't want to drag on to that. So let me just kick off by showing you a few things. Oh, that's a Tesla chart. That's not the one I was looking for. I'll show you a few things which are, and I'm going to keep this broad-based. This is a free webinar, so I'm not going to go through every single nuance of every single line and stuff. But here you have what we call a Fibonacci retracement. Now, Fibonacci retracements are normally used on massive breakouts or big breakdowns. This is the latest of the flash crashes. I've shown you guys. Actually, I'll start off with this, which I've shown many times on my on the Twitter feed. And remember, you can find all the charts for clear viewing under the media section on the Twitter feed. So here we are. This pattern symmetry is pretty amazing. Look at this one. Let me change the color. Forget looking at all the numbers and stuff. Just look at the shape. It is pretty much exactly the same. Not this one. This one's a little bit different. Okay, so I'm letting this one out for now, but we'll cover that as a third pattern symmetry. But I'm focusing on these two, and I highlighted them clearly to show. So first of all, this happened on this move happened, this breakout, just the way these are consolidation channels. You guys get that by now. So this is where the markets trade in a range, and then it breaks out. So it broke out around the 21st of April. Decided to move up fast, move sideways, moved up a little bit more, and then suddenly dropped. Okay? And this was all during the reasons behind that was the FBI investigation, all that stuff, and other reasons that were there. We're not going to get into that because we're just looking at the pure technicals. So we suddenly dropped. We closed the gap here. That's a gap fill. That's why I write gap fill. So we closed this gap, and then we decided to turn and go up very fast for the first 3 days, and then we eased back, went up a little bit more, and then we went up more. So that went up to the upper end of the third channel. Channel 1, Channel 2, Channel 3, Channel 4. So we're concentrating on Channel 1, 2, and 3. So let me move these lines here. So when you look at this move here, this is exactly similar to this. There's a gap fill here. The only thing that hasn't been completed from a technical standpoint or checklist is this gap fill here. Then this is the S&P 500, by the way. This is not the E-minis. You don't have to convert it to the S&P 500. So the bottom end of this gap fill is around 24.29. You can see that. And the upper end of this gap fill is roughly 24.35. So that hasn't been fully filled yet. In fact, if the futures were down 950, I'd have liked it more, if you ask me, because that means this gap would have been filled after hours, so we would start the day with the gap filled. So if the futures open up $9.50 tomorrow morning, then that means this gap has not been filled. It's not mandatory that gaps have to get filled, but hey, you know, from a technical, if somebody is a very strict technician, they would like this gap to be filled. That's why I have this arrow here. This gap did get filled. You can see that. This one hasn't. So from a pattern symmetry standpoint, very simply, if the market decides to move higher, and even in this particular case, there was a minor gap here, minor gap, that also got filled before the market decided to move higher. But you can clearly see here that the market right now is resting, and I'm going to highlight this. This is a daily chart, so it cuts out a lot of noise. Is resting, is trying to break above, and maybe it already has because futures are up 950, right on this red line here, right on this red line, which is the 50-day moving average. I do not believe that the economic fundamentals of the market at this point dictate a sharp break of the 50-day moving average for a elongated period of time. In other words, for a simple English, I don't expect, just the way here when it broke, a lot of people, even some people in our group, that's it, 50-day broken, it's all over. No, it's not all over, because the 50-day moving average is, classically speaking, is a very powerful moving average. So breaking it and losing it for a long time means we are on the brink of a much more longer corrective move or pullback. So it happened here. It happened here. That was back in early April. It happened here for a day. That was back in March. Okay, and bottom line is that it happened here now, currently, and we are trying to regain that 50-day moving average, which we actually have based on the pre-market, after hours futures, which are up 9, because we closed at 24.41. 50-day moving average is approximately at 24.48. So we're actually above the 50-day moving average if you know on the E-minis, which basically means on the S&P 500 at this point. So I don't think that we are in a prolonged move down yet, but I'll explain to you what the downside is also. And if that happens, that means that there is some real fundamental weakness on the market, which will continue. However, for that to happen, you would like to see these two lines. And when you look at my charts, you know, I will certainly point it out. The 34-day moving average and the 50-day moving average make a nice sharp move down. That's when you know that things are really getting hot and heavy on the downside. Okay? But we're not there yet. And there are conditions, which I'm going to show right now, which are extremely, extremely, and similarly oversold, where we have had these reflex bounces. Now, the reflex bounces doesn't mean we have to make a new high. It simply means we're going to bounce. How far it bounces, yet to see. The candle development over the next 24 to 48 and 72 hours going into Wednesday is going to tell us whether or not we're going to have a prolonged bounce into the end of the month, or whether or not we're going to basically slip down. So keep looking at this chart when I put it out there, because this has been constructed to perfection for tactical traders, which I think everyone should be. Emotions will never run away, but you have to be tactical and stay as normal as possible instead of freaking out just because the Dow is down 60 points. Doesn't matter if somebody makes a comment about it, this and that. I'm just saying that for your own good, looking at the Dow down 60 points or the NASDAQ and individual stocks down hard on a certain day because the machines are going nuts because the VIX is up 44%. So there was a lot of cross-current arbitrage trades going on, means nothing. When Amazon drops 20 points, what, fundamentally something's changed about the company? No. It doesn't mean anything really about the particular company itself. It is just that the machines are doing some chop, 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 and prices are all over the place. And the following day, it goes up $11 on Friday. And maybe tomorrow, with the futures up 9, it's going to be up another $11 at the open, or $5, $6, $7. You've seen that happen before. So this gap fill is what in my opinion, should get filled. If it doesn't, then it's going to follow this pattern, which means that we are going to basically head towards the upper end of this move here, which is 2474. And I'll show you that on this Fibonacci retracement chart, which is very, very, very critical for tactical traders, because you know pretty much how far things can bounce. Very, very. I like to make things as easy as possible so you guys can manage your trades better. That's really my goal, and that's all. Now, if this gap, if the market falls below this gap, then we have a lower channel to deal with. That lower channel is a round number of 2400, which also happens to be this nice white line here, okay, which was the big breakout back in May, failed breakout back in early May, big breakout third week of May, failed breakout, attempted breakout on March, but it did break out. So 2400 is psychologically and technically a very important number. If we break 2400, so 2400 from here, where we closed at on Friday, means roughly 240 point drop. This, 41 S&P points from here to here is roughly 240 points in the Dow. The world is going to be lit by fire and fury. You're going to hear the media talk about the end of the world. That's it. Bull market over. Garbage. All it's doing is testing the breakout level. Now, we have to be positioned right in order to do that, obviously. But that'll only happen if we break below this level here and fall into this small gap. And that small gap, ladies and gentlemen, right here, from, let's say we fall below the 2431 gap, and these numbers are very critical to all the other stocks that you trade, because stocks will follow alongside it. You could be all the way up in a Regeneron on 14 points. It'll just, the machines will come in within a split second. It'll be down 20 because the SPX and the S&P 500 will pull down everything, because everything is electronically correlated, right? So you can be like, oh, why is he talking about the SPX when I'm investing in individual stocks? Well, if that's the mentality that if traders have, then they're really living in a la-la world. So I don't even know. You know what I'm saying? Everything is correlated with the broader market, especially the S&P 500. So you can't run away from it. So you have to understand what's happening in the background in order to manage your trades better. So this move here, if it breaks from 24, what did I say the lower end of this gap was? 2429 to 2400 is 29 points. Let's call it 30 points. Multiply 30 by 6, which is a rough number that I take. That means this drop is roughly 180 points in the Dow. And all the market is doing at that point is retesting this big fat breakout that occurred back in at the end of May. And we almost retested it here again in early July. If we break the breakout level, we have some major support, which are critical supports in my opinion. That's at 2383, which is 100, and this magenta line here is 150-day moving average. Okay, which is used primarily by hedge funds and institutional traders. 150-day moving average is at 2383, and then we have the next level of 2380, which is my own channel that I have drawn for a while. Let me go back to it again. There, which is 2375. If all of a sudden the North Korea thing, the tensions ease, and believe me, there's a lot of back channel diplomacy that some of our very smart, and I put a fantastic article out there for you guys to read too, that is happening in between the rhetoric that's going on. Okay, and there could be a viable solution, a moderate solution to calm those guys down. So bottom line is, that happens, we are going to zoom up, and believe me, I'll tell you, to 2573 so fast heads are going to spin. Now 2441 to 2573 is a 2573 is 132 S&P points multiplied by 6. That's a whopping 800 points on the Dow. Somebody would say that's not possible. No way. We're not going to go up 800 pounds on the Dow. Well, that's what they said to us when we were at 220, right during the elections, when I projected that this market would basically be a Brexit on steroids. In other words, it go up tremendously after I started noticing this big fat buying in the first couple of days. And things started to come off some deep oversold conditions where we are almost there right now. So these things can happen. What if banks really woke up? What if energy stocks woke up? The Saudis are not sitting around. They want oil at 60. Oil at 60 means Exxon, Chevron, EOG, even the little MRO that we trade, Marathon Oil, and so many other oil companies are going to fly. That can easily add another 800 points on the Dow without too much sweat. That means upper end of the range. Now, I'm not subscribing to that uber bullish scenario. I'm simply saying that it is possible. More likely, on some moderation of tensions with South Korea, with North Korea, we will basically end some healthy talk coming out of the Trump administration regarding tax reform, infrastructure spending, and stuff like that. We could very easily come and test the mid channel here, which is 25.18. Almost all retail traders, including many of our members, no fault of their own because they're victims of their own emotional demons, can never imagine that the market can actually make a new high of 25.15. They've written it off because of some sort of intraday losses that have been taken on some lottos of all things. Okay, so they're just like, that's it. No way, this market's not going high. They're reading all the significant amount of bearish garbage that's coming out. Not necessarily garbage, but lots of heavy-duty bearish talk coming out of StockTwits and many other forums they're monitoring. And they're just like, no, we're definitely going down. Okay, so I'm showing you what we can do on the upside or the downside. So, bottom line is that if we do fall, this is critical support. And I don't want you guys to project that far. I'll be walking you guys through it. We will certainly initiate short positions hard if we break below this gap, because then we're going to drop to 2400 real fast. Technically speaking. And then if we break out over this channel here, we are going to basically get towards 25, what did I say, 18. So that's not been written off the books yet. We can in fact print that by the end of August. And how much is that? 25.18, because a lot of people think of all these in terms of the Dow Jones Industrial Average. 25.18 is 25.18 minus 24.41, where we closed at. We are talking about 77 S&P points. That would be from here, where we are. That would be from where we closed at, simply to the mid-range. That would be a new high. That would mean roughly about 460, 470 points on the Dow Jones Industrial Average. Can it happen? Absolutely it can. And there will be sell-off at that point, because every single time it comes to the upper end of the channel, the market sells off. That's why these tactical charts are drawn by me to benefit all of you, so you know where you stand in the framework of the ranges. So this is the pattern symmetry we're looking at. This one did fill the gap. This one didn't fill the gap yet. It could happen very quickly, within 24 to 48 hours, regardless of where we open tomorrow morning. It can happen on Tuesday. There could be a flash news coming out that North Korea tested another ballistic missile which landed next to Japan. You'll see the market drop 200 points in 2 minutes. Nothing to be like, oh wow, that's the nature of the business, guys. So I'm giving you all the probabilities. That gap could get filled, or we could slip down here if things really ratchet up. And of course, you don't have to figure this out yourself because I'm putting everything out in real time. Just want you guys to understand what the possibilities are. If this gap gets filled, we could move from here like we did here. Or we could slip down towards 2400, which is roughly 160 points from where we closed at. I'm sorry, 240 points from where we closed at, which in my opinion would create a sharp tactical bounce And it's a tactical bounce, because then we'd have lost the 50-day moving average by a nice standard deviation. Means that we would have moved away quite a bit from the red line, which is the 50-day moving average. And that means the bounce would project, if we fell like this, the bounce would project itself to find major resistance at the 50-day moving average again. And if we broke above that, great. If we didn't, we're going to fall again. Now, that's the front side of the picture. And I'm sure if anyone has any quick questions on this particular chart, feel free to ask right now, because I'm going to be moving on pretty quickly. Any quick, does everyone see the pattern symmetry that we are talking about here?
Yeah, Frank, I got a question.
Yeah, go ahead.
Let's say, for instance, let's say we lose the gap. What do you do with your options that you have sitting out there on other stocks? Do you start cleaning them out if it starts falling?
You got to clean them out. You got to clean them out, because otherwise you got to grit your teeth. Let those options sink in real deep and buy here. Okay, so in other words, if you are going to lose this gap, there is going to be a sharp sell-off in the market. So you can either, if you have, that's why I say you buy a little bit moderate amount, because this is a bull market. So what happens is everybody's looking at this gap, or maybe the smart money is looking at the gap. I don't know. I don't hear anybody talking about the gap here on Stock Twits or any other forum that I look at. Okay, so let's say but generally speaking, when everyone's looking at it, sometimes it doesn't get there. You've seen that, Corey. Okay, so the bottom line is that if it falls, you got to act on your options, which is a very good question. Look, key part of trading is you should be ready to basically move your money around, because the whole point of trading is that your P&L survives. You cannot have a P&L green every day. I just want to remind every single new trader, old trader, medium-sized trader, okay, your P&L or profit or loss cannot be green every day. You should measure your P&L on a weekly basis. Period. I know it's not hard. It's almost hard. Like, oh my God, he's asking us to look at our P&L on a weekly basis. Well, yes. Because if you measure your P&L every single day, oh, I'm green, I want the market to end this much higher. You know what? It's not going to do anything for you guys. Because what you're going to do, your brains are going to make you do stupid things at the end of the day, because one red candle automatically gets generated by the machines. That's why I don't give two hoots on this market, on close buy, on sell orders, because you guys know better than I do that they mean hella beans what the market is going to do the next day. Am I right or wrong?
Right.
I am right. The market on close order is great. There's 500 million to buy. What does that mean? That tomorrow is going to be a great day? No. It simply means the ETFs, or exchange traded funds, which dominate the landscape, are adjusting their portfolios at the end of the day. Maybe they were short. That's why they have 500 million to buy and covered their shorts. Does that mean that immediately it's going to go back up the next day? Nope. It helps to know that info, but it doesn't dictate your trading for the following day, guys. So bottom line is having moderate position at critical levels in the market, and I'm going to dive into the internals right now, okay, means that you could sustain a drop, cost average down at that point, because you have the cash on the side, you didn't lump in at one go, and then you move from there, or you sell. Because if the drop is going to be sharp and fast, you got to allocate money towards the put side, make money on that side, but you need to have that ability and the flexibility to do it. I can't help anyone with that. They got to do it on their own. And we have several times, we have gone short intraday and scalped decent amount of profits during that day. But I don't like staying short too much overnight, regardless of what people tell me, is because these markets at critical levels can snap the back of the shorts like they did on Friday, and like they're doing right now after hours with futures traders who were short. Now they're basically losing money hand in glove, because the futures are up 9 points. And NASDAQ futures are up right now 32 plus points. So let's look at the internals. This is a daily chart. This is cutting out a lot of noise. Every single time we get towards these levels, in my opinion, we're not there yet. But it doesn't have to be like immediately there. Market starts moving up right from these levels here before they reach the bottom. Okay, these two moves were approximately 100 plus point on the Dow. I explained it in very precise detail to all my ACS students when we did the session yesterday. I'm not going to get into that in the general session. So the bottom line is, by the time the turn happens, the market is already up when the stochastics, the full stochastics, which is the first derivative of the relative strength index, key trading tool, the RSI. Here the RSI has broken below 20. It's at 17.7. But there is no sign of a turn yet, as you can see. By the time the turn comes, right, the markets generally, the Dow Jones, I'm going to put DJ, are generally up more than 100 to 200 points. In the case of the options on the S&P 500, this is what we're talking about right here, okay, 100, 200 points means that you are up pretty decent sum in north of maybe 150%, if not 200%, on the calls on that particular trade. So by the time that you see the turn, it is confirming that the market will have a couple of extra days of going higher, generally speaking. So by that time, you have already not made, by not positioning at these levels, as I've put out to selected trades and SPX calls and stuff going into next week. I said August 18, multiple times. And if you bought little bits of it, and we get a turn, you'd be, and we get a turn like that, you would be the first beneficiaries of these very tactical early moves, which I tend to get specialized in, as you know. By the time that this confirms, I repeat, the Dow Jones will be up more than 100 to 200 points, but it will give you a better confirmation going higher. However, by that time, the candles, generally speaking, as you can see, get smaller and smaller. The biggest candles are always off there. See the size of these candles? It keeps on shrinking as it's moving higher. So this big fat candle came from here before the turn happened. At this point in time, without going in any more deeper, and feel free to sign up for the ACS sessions if you really want to learn the craft, that's the way I look at it, is the bottom line that we are at that zone. We're getting there. At that zone. It's the simplest way of looking at it. This was right before the November elections. We went significantly lower. We went to like a 5 on the RSI. We are still at 17. I don't really look at the numbers. I look more at the pattern. Whichever the case, you can clearly see we're very deep oversold. You've heard more than 40% of S&P 500. S&P 500, not Russell 2000. S&P 500. There are 500 stocks in the S&P. That's why they call it the S&P 500. More than 40%. That's close to 200 plus. I'm sorry, more than 80 companies. No, what am I saying? 40%. More than 200 companies on the S&P 500 are trading below their 50-day moving average. Whoopee. Is that an opportunity? I look at the glass half full for reasons that I explained before. 40% of companies, and people are telling us that the market is severely overvalued. Yeah, great. You know when market is severely overvalued? When more than 80% of S&P 500 companies are above their 50-day moving average. I repeat, more than 40% of S&P 500 companies currently are below their 50-day moving average. So even if 20% of them, let's say in the energy arena, bounce, the market will go ballistic. In the meantime, we have these lower levels to contend with if things go the other way. Let's take a look at more tactical, immediate positions of how you can trade the market. You can see that clearly. I told you it's going to hit the downtrend line. It hit the downtrend line. I told you it's going to find resistance. That is exactly what is going on in real time in front of you. Ladies and gentlemen, you see a red candle? This is not rocket science. This is just precision drawing. You guys can do it too. Now, does this mean that this red candle is going to pull back? Yes, I think so. Futures were up almost 9.5 points. They're up 8.5 points because of this little candle. Is it possible that it busts a move up here and gets towards the 50% retracement level, which is generally the standard level that and it happens with stocks too. When you have a climactic waterfall decline, this is what it's called. This is a waterfall decline, okay? When the dam breaks, creates a nice fat double bottom, even though the gap fill is down here a little bit, right? Remember, the 2430 I talked to you about is this is 2435 on the S&P 500. Remember, you have to add 5 points to it roughly. The 2430 that I told you about, that the gap gets truly filled, is on the S&P 500. So that means this has to be at 2425. So let me show you where it needs to go to in order to completely fill the gap. 1 second. There. So I'm going to draw a line here. Perfect. And I'm going to make it really thick. Took 5. I'm going to make it a dotted line. There's your gap. There's your gap. So my point is that that gap hasn't been filled yet. Does it have to be filled? Nope. There's a good probability it might. So by the time people get super excited about buying it because they're looking at the prices, oh wow, everything is high, the algos are going to be selling hard. They'll be selling hard at the resistance. They'll be selling hard at the next Fibonacci resistance, which is 38.2%, okay, which is already printed here for everyone to see, 2452 on the E-minis, and 50% retracement, which is a massive resistance because that's where the 150 SMA, simple moving average, comes into play. If we can break above that, we're going to make a new high. Period. That's it. It's going to happen. It's going to happen fast. However, currently, chart pattern looks great. However, this can very easily, on one news flash, and we got some big news stuff. There's a press conference from President Trump tomorrow. I believe he's going to talk about putting some strict pressure on China intellectual property, that they basically take a lot of our intellectual property, you know, technology companies, and then make their own stuff using our intellectual property. That's been going on for a lot of years, and I think that's really bogus that people do that. But hey, countries do that, right? They're basically stealing our intellectual property and making something which is a copycat of an Apple iPhone. Of course, they should be punished for that. Markets might not like it, because that might mean a trade war. China might put some sanctions on a bunch of stuff that we're selling to them, and we sell a lot of stuff to them, guys. Okay, so markets can easily do this. That would be the gap fill. So don't get all like, you know, jiggy and like feeling good because prices are high on a Monday morning, futures open up 9. That's why you rely on charts. This is your roadmap. Print it out, look at it on my screen. You know, when I'm putting it out there, I put it out quite a bit. And these are the markers that the markets are going to go to. These lines curving up is great. What we didn't want is this line, the orange line, to curve up. This is a 1 hour chart and basically move, and it cross over the 50. That's when you move. Now, this is a 1 hour chart. What's happening underneath? We're already overbought. So players and traders who bought moderate amounts down here, and if the market does open up 8, 9 S&P points, should be the first ones to sell. Let's take a look at the 4 hour chart, which is the closest cousin to the daily chart. This you can apply to stocks too. 1 second. The 4 hour chart is looking pretty damn good, to be honest with you. Look at it underneath. It's a double bottom off some deep oversold levels, 2.81 on the stochastics. Wow. Okay. Back in June, we had a massive candle reversal off a big, ugly crash. Okay. Nothing new on the 29th of June. It was the last day of the second quarter. They were just like portfolio adjustments, hardcore stuff going on. After a nice fat move, suddenly the market gave in at 1 o'clock on the 29th. I mean, that was actually futures. That was 1 in the morning. Markets opened up and then turned around at approximately 1 p.m. You can see the time here. Created another double bottom. That's the nature of volatility. Don't take anything at face value. Track the charts. That's how you win, or at least lose less.
Hey, Frank. How does the 4-hour stows correlate to the 1 hour? Let's say the 1 hour really has a big pullback. Does the 4 hour get hit pretty hard too?
Yeah, but it's a simple thing of law. The closer, it's like, imagine this to be, here's an analogy. You have a microscope. Okay, you're looking through a microscope. The more you zoom in, that means that the 1 minute chart, for example, this is, let me start off like this. This is the 1 minute chart. It's got more wild gyrations than anything you can imagine. Yes or no? Correct? So it's like your microscope is zooming in really hard. I don't know if you guys in high school or college ever went to biology class. You know, you put a plate, you put a drop of blood. You know, they basically want to show you the platelets and all that stuff, white blood cells and all that stuff. So bottom line is you zoom in really fast. It's like little things, dots, like really moving, right? So that's a 1 minute chart. So if dots are moving like this, you are basically a monkey on a hot tin roof. Every single price movement, you're like, whoa, whoa, yes, woo. I can't even make the sounds. You know what I'm talking about. You're a complete monkey on a hot tin roof. Okay, that's a 1 minute chart. So then we're moving on to, let's say, the 5 minute chart. It smooths out a little bit more. You start to see a trend. Let's say you move to the 15 minute chart. You start to see a better trend because now the microscope, you're basically pulling back. You're not zooming in, you're zooming out now. So you're starting to see a picture developing. Ever want to go to a nice art gallery and stick your nose on the actual picture and try to see what that whole picture depicted? Try doing that. All you see is like these colors jutting around your eyes. Yes or no? Right?
Yeah, true.
Yeah, exactly. So the same thing with charts. You got to zoom back a little bit. Take a breather. Look back. That's why I don't show 5 minute charts. I use them in trading sometimes. But why should I show 5 minute charts? Because in 5 minutes, that chart's going to look completely different. If you want to use it, sure. People get signals of 5 minute charts. There's no problem with that. That's why they're there. Now, let's say I'm moving out to the 30 minute. I'm seeing a better picture here. Then I'm moving out to the 1 hour. I'm seeing a more clearer signal. Then I'm moving up to the 4 hour. Then I got to zoom in at that point. Here's your 4 hour. So in answer to your question, when the 1 hour starts, when the wave hits upside or downside, the 1 hour, for the smaller time frames, 1, 5, 15 minute are going to show the most gyrations. The 30, 60 minute, which is the 1 hour, is going to show lesser gyrations because the noise is being, you're basically zooming out, right? And the 4 hour will basically show you lesser gyrations because will it get hit the same? Absolutely, because it's the market. If the market drops 50 points, is the 4 hour going to drop less than 50 points?
No way.
Exactly. See, these are very simple concepts that your brain has to understand. If the market drops 100 points, okay, does that mean that the 5 minute is dropping 100 points, but the 4 hour chart is dropping less than 100 points? Come on, I need straight answers because if this is not clear in your head, exactly, it means the overall market is down 100 points. You get it?
Exactly. Your analogy is great.
Right. So the bottom line is, but the way you view it is going to look different because the 4 hour is going to cut out the minute noise and the fluctuations of the 5 minute and the 15 minute. You get it? So the 4 hour works fantastic for swing traders and for during extreme conditions like we experienced last Thursday and Friday. So that's why for swing traders, the 4 hour is great. So looking at the 4 hour chart here, and then the daily, of course, cuts out. Look, the daily hasn't turned yet, right? But like I said, by the time it turns, the market generally is already up 1 or 2 candles, which roughly means anywhere from 50 to 200 points. But it hasn't turned yet. So that if somebody wants to be a pure technician, they'll say, you know what? This is still telling us that we are still going down more, which means the market can fall more, correct? This is what it looks like. This is what your Fibonacci retracement looks like on a daily. First candle, second candle. But if we look at a weekly, the weekly is still heading down. So People, a lot of these old-fashioned traders, they like to say, "Oh, we're not in the safe zone yet." Freaking, what's a safe zone in the market? I don't know what a safe zone is. By the time a safe zone comes, the market's already like dropping 200 points. Oh, we're not out of the woods yet. You hear a lot of that stuff. Well, the whole freaking market is a forest. So by the time you think you're out of the woods, you are basically, when the market goes here, for example, they'll say, "We're out of the woods." Because from here to here is another 120 points. So, wow, we're out of the woods. Yeah, right. Because right there, you're going to see some big block sells that are coming through. So that's why tactical trading is so critical in you managing your profits, because there's nothing out of the woods. These are volatile, range-bound markets, which at certain times break out or pull back. So think about the market that way. It's a fundamental shift in thinking, which traders need to really practice. You got to tell your head, there are no breakouts or breakdowns. There are simply ranges you're trading. Yes, individual stocks can break out, make a new high, make another new high, but a lot of large individual stocks don't generally break out. And Corey, you know that, and everybody else who's a half serious trader knows that. It could be up 20 points, next day, boom, sell. Program comes in. So the market should not be always looked at, oh, it's going to break out or break down, because that's not the nature of the machines. So looking at the 4-hour, going back to what I was showing, looking at the 4-hour chart, this is actually very positive. I will, like they say, this is not fake news, like Corey likes to say, this is real stuff. So real stuff is telling us that it's looking pretty nice. You're seeing a double bottom reversal. That means that the chances, and this yellow line, that's your trader's friend. You use the 9 SMA, I use the 5 SMA. 5 trading days in a week, I like using the 5 SMA. The 5 SMA now is acting as upwardly rising, and every time the market's pulling back, where everybody's kind of freaking out, oh my God, here we're down 30 points, all that stuff. And I show many different charts. I'm just showing you Thinkorswim tonight. I use the Algo HFT quad platform, which is fantastic. And the next free webinar, certainly just spend a lot of time on that. I do have videos on that, how to read that very well on my YouTube channel. Feel free to look it up under the new beginners video, training videos. It's all there. So bottom line is, I'm not just relying on this. So at this point, very simply, this is this is nice. It's a hockey stick. Okay, this is nice. So this will support the movement higher as long as the stochastics keep on moving higher. Once we get above 80, back to the story. They're going to sell the market. That's called resets, up or down. I don't care what they tell you out there. This is the way the markets operate. The longer you wait, thinking you're feeling in a comfort zone, the trade is over. And it doesn't mean we're going to crash and burn. It simply means that the so-called easy money, which is made, easy money is always made at the most difficult junctures of the market, such as what we witnessed on Thursday and Friday. That's what the easy money made. People, the perfect moment. Well, for tactical traders, these are the perfect moments. The perfect moment to sell, at least on the index side, this. Did I expect a massive drop like that on Friday and the VIX jumping 44%? Absolutely, I didn't. First one to admit. And many traders use my tools that I provide and do their own thing. Some of them shorted, made a bundle on these drop. I didn't expect it to drop that fast, that quick, but it happened. But it created, there are many ways to skin a cat, but it created a beautiful short-term buying opportunity. That is what I'm showing you right now. Whether or not the market's going to make a new high up here, I don't know. So this 5-day moving average, sticking back to it, is telling you that it's going to act as support. Okay, it's going to act as support. So and this applies to stocks too. So if it acts as support, futures are here right now. Let me give you an example. We're up 8 points. So we are at 24.48 right now. So we're right there. So if the futures drop right now back to retest this upwardly rising line, which is the 5 simple moving average at 24.44, the futures, that means, have dropped by 5 points, correct? Do you understand what I'm saying?
Yes.
If this pulls back,
Yes.
that means
Yes.
futures are, instead of being up, would be only be up 3. If somebody was just watching prices, they're like, man, futures were up 9, now they're only up 3. Oh man, this market really sucks. Well, no, all it did was come back to retest this upwardly rising yellow line, which is the 5 SMA, and most probably will bounce off here. Laws of nature, like a slingshot, like I've explained before. When you pull it back, kinetic energy is, the rubber band, as it pulls back, builds kinetic energy. You let it go, bang goes the slingshot. Throws the projectile, whether it's a marble or a rock or whatever it is. Right? But in order for that kinetic energy to develop, a slingshot, which generally looks like this, and you basically pull the rubber band back, and then boom, it shoots the projectile out. But if you don't pull the rubber band back, i.e. don't have these corrective minor pullbacks, in bigger pullbacks in markets, but minor pullbacks during short-term trading, then where are you going to get this kinetic energy from to throw the projectile out? That is the law of physics that applies to markets too. So little pullbacks based on tactical levels are a positive, not a negative. Markets keeping on going higher are a negative. Markets going up like this between ranges and then breaking out are a positive, because it builds a lot of energy. A lot of weak traders, weak minds, lazy, I will openly say that, don't want to understand what tactical trading is all about. Forget about it. Tactical charts are all about. Never capitalize on these moves. This has been happening since 2009, which was the last depression lows of the market. They always want the market to go like this. Guys, time to wake up. Markets go like this. As long as the overall trajectory on the market is higher, you are going to be bullish and capitalize on tactical drops. It's the simplest way I can explain it. Let me just show you a couple of other charts, and then I'm going to sign off. And these are very important. I showed you this one. This is the short-term roadmap of where the markets can go. I'll be showing that. You can see here we have a red candle developing. I can almost bet, and I'm not a futures trader, that it's going to come down here, freak out a bunch of non-tactical traders who are trading futures right now or watching the futures and say, oh man, they just futures just lost 4 points. Only way that it's going to be negative is if it breaks below this upwardly trending yellow line and then breaks below, and then in which case we're going to go back and retest 2430. In fact, I want the 2430 and the gap fill to happen before we start trading tomorrow morning, for obvious reasons. Gives us a much better entry point, and it completes the mandatory requirements of technical analysis, which is a gap fill. Am I clear on that?
Yes. Hey, Frank, if you were trading this now, you would probably be selling your future and
Correct.
waiting to try and buy it back at that 5. You'd nibble at the 5 SMA, right?
Correct. Absolutely. Absolutely.
Oh, I got it now. I see what you're doing.
Okay.
Wow.
I use the futures as a proxy during daytime hours because they trade the same way, right? So I'm using the futures not because I'm trading the futures, guys. By now it should be obvious to everyone. During daytime, I'm using them to find those levels that I constantly keep on showing the ES chart, because that ES chart is going to determine whether or not you will retain your profits or give it all back to Mr. Market. Generally speaking, it's correlated very well. So futures, when they drop like this, you know the market's in the crapper. I don't know if the candle is going to develop like this, but hey, when you see a candle like this, I didn't have much large position. We have lottos and stuff, so I didn't really care about it much, even though it fell. The NVIDIA trade on the option side didn't work out. On the common side worked out after hours. So things like that. So it was rough. Bottom line is that, yes, I would be looking at it here and say, okay, And I wouldn't be trading off the 4-hour chart. I would be trading off the 1-hour chart, to be honest with you, because the 1-hour chart is very clear. Look, it hit the 50 and you got a red candle. It's going to come down, test this here right now. And then if it bounces, it's going to hit the downtrend line, which I drew. This downtrend line is drawn exactly. That's a perfect downtrend line. That's exactly where it hit. Once it takes that out, shorts are going to cover in the futures market. We are going to be up to maybe the 38.2 Fibonacci, which is 24.52. That means the futures will be up 13 points. And so people will be like, oh, wow, look at that. Futures are up 13 points. It's going to give more juice to the after hours market. But at this point, we're overbought. And the same thing applies in real-time trading. It's overbought. So chances are it's going to reset a bit. Let me move on to, so we covered the short-term chart, so you understand what the levels are. I showed you the pattern symmetry, what can happen. We could fall below here. Closing the gap would be very positive. Bounce up sharply over this level here. This orange line, which I've written all this on my Twitter feed, of 2450, 2453, 2454 would be very positive. That means we have broken above this breakout line here, 2453. That was another breakout, as we all know. This was the initial breakout. That was a secondary breakout. That would be positive. And if I see the daily 5 simple moving average start to turn, you know they're going to rip this market higher. So if this turns, and this will only turn if we get up towards those levels. That means if the market's up 100 points or so, this yellow line is going to start to turn. Once you see the 5-day simple moving average, remember we're looking at daily, curl higher, you can basically stick with the swing trade with the combination of the stochastics going higher. And I show that very clearly on each one of my charts. And you can stick with the swing trade regardless of intraday fluctuations. Of course, you manage your profits. If you're up big, you want to take some money down. But at least you can stick with that trade and stick with it. That's where patience and discipline. Look, patience and discipline is not the normal traits of a human being. Human beings are impatient. We want rewards now. It's called hyperbolic discounting. If I told you you'd make a lot of money 5 years down the road, you basically said, no, give me the money now in 1 week because I don't really care what's going to happen in 5 years. That's called hyperbolic discounting. So we constantly keep on taking short-term profits and leaving nice, fat, longer-term profits on the table. And, that's just human beings. That's I can't change that. That old saying that 2 birds, what is it? 2 birds in hand is better than 3 in the bush or something like that. Well, what can I say? So as long as this cooperates and this, very simply, the 5 simple moving average turns, you're good to go. You got to stick with the trade. Let me just go through a couple of other very important charts. First of all, the S&P futures volatility chart. This chart can't get any better than the way I've drawn. Okay, you're seeing the face of volatility in front of you, and you can go all the way back or you can zoom in. Now this is on investing.com. You can replicate the chart. You need some help in setting this up, I'll be more than happy to do that for you. It's all lines and precision level. Breakout level, that means this green line. Okay, that was the breakout level on the market on July 14th, right here. This was the last sell-off. This was the breakout. This was the breakout on July 14th. On July 18th, just a couple of days later, we came back and retested that breakout. Remember, this is the breakout level, right? That's why I put these arrows. We retested it and took off like a rocket. This is another breakout level, this big fat green line. All right? This was the initial breakout. I consider this to be a more viable breakout. Well, guess what we're doing right now? We have crossed over that green line. That's why this green line is here. And we're heading towards the real breakout level, which we went through on July 14th. This is called pattern recognition. Anybody can do it. All they have to do is focus. This is not hard. Now, it is not hard, but a lot of people who are not used to looking at charts or refuse to spend time looking at charts, and we have many traders like that, and that's okay, each to their own. They are just trading off prices. I see patterns very quickly because I've been doing this for a while. But it's not me. Anybody can do it. So I see what these points of supply and demand are. Red means supply. That means a lot of sellers, right? A lot of sellers. And green simply means a lot of buyers at those levels. That's why there's a green thumb here, or green arrows that I use. So those are the demand points where the demand to buy is higher. So I look for those, and that's exactly what the markets are going to fluctuate in, because that's called support and resistances, right? Support is what something stops falling because there are more buyers who are stepping in there, thinking that it's cheap and valuation's better, blah 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 blah, all that stuff. The valuation concept to me is all garbage. What somebody thinks is high valuation, somebody can make a point, okay, a very powerful presentation that it's not overvalued. At certain points, things do get overvalued. We are very far from that in this market. Let me just tell you that straight out. They keep on saying the market's at 19 PE. Really? I can show you 8 PE on certain energy stocks. And what is just PE? Growth companies should be measured, I repeat again, I've said it many times before, under PEG. That's price to earnings growth. Because it's all about growth. Why do you think tech stocks are so strong overall? Because that's the only sector of the market which is really growing really, really fast. 40% growth, 30% growth. Even when they're missing numbers, their growth rate's higher. Show me what real solid tech company which is going backwards in their growth. None. Because that is the future. We can change the dynamics of global change, technology. Just the way we went from a agricultural farming back in the 1700s and 1800s agricultural economy to a machine-driven, more industrialized economy. Same thing happened in England hundreds of years ago, right? The Industrial Revolution. Google it, read it. A lot of people were displaced. There was a lot of misery because they couldn't figure out these things that are in the factories, which are doing with their hand. Well, it's the same thing happening right now. So there's going to be a whole cross-section of people who are going to be extremely unhappy, and rightfully so. What are you going to do? Life ain't fair. You got to adapt to the new skills, whatever it takes. So computers are displacing a lot of people, right? But you can't go back in time, regardless of what we want to do. You got to help those people in a different way. You got to retrain them. You got to give them some basic subsidies so they can lead a normal life. But they got to force themselves to learn. Because nothing's going back, guys. Technology can only move forward. So, saying all that valuation thing, I give very little merit to that. I like hearing it. A lot of you guys post some fantastic stuff on certain companies, and they want to analyze downgrades. Okay, it's all fine and good. I'm not saying that the analysts are idiots. They're very smart people, but they are victims of their own cognitive bias, which means what they believe in. Tesla is overvalued. Great. Why don't you segment out Tesla between SpaceX, their car division, which is going to be losing money for years, guys, by the way, all right? And their solar division and their battery division. The SpaceX alone is worth the 80 to 150 billion dollars. What if Tesla came out tomorrow and said, you know what? And believe me, Wall Street's working on it. We're going to spin off SpaceX as a separate company. Tesla will jump 100 points in 5 minutes. Because the spin-off unlocks intrinsic value. That's how investment banking works. When EMC, a company which you guys might remember, at that time it was the most powerful company on data storage, spun off VMware, EMC stock just jumped because it unlocked value. This was years ago. So, getting back to it, that's another day's story. And and a reminder, people want to really learn all this stuff. I teach all this, which I do. It's a lot of time I spend, hard work. Got to sign up for the advanced coaching sessions. I'm not going to keep on teaching people everything about the markets and spend my hours staring at my screens in the middle of the night. So real simple, just pure capitalism, guys. All right, and I keep all the price stuff real cheap. I mean, real cheap. Go try to take these classes with some other services. and you'll know what I'm talking about. So bottom line is that that at this point, this is the face of volatility. I follow this very closely. You guys can on your own screen. This has to be followed on your own screen, and it has been drawn. Each line are major inflection levels. This is another major breakout level in the market, and I trade these candles. I mean, you can trade these candles. And where are we now? Oh, we're right there. This is also very easy to see in the stochastics. Now, this is the fast stochastics. It's 1413. The other stochastic that I showed you guys on this is what happened to it? Hold on. SPX charts. This stochastics is 80-20-10. That means it's more of a full stochastics. All right, fast and it's a full stochastic. Yeah, that's exactly what it is. This one, when you is 1413, that means it's a fast stochastic. So it's going to move much quicker. So, and I show that on my algo charts. Fast, slow. You want to stay with the trade, you always focus on the slow and steady. When the slow gets deep oversold, Mr. Stowe will deliver the goods for you. When the slow stochastics are overbought, you can rest assured the markets will correct one way or the other within a very small time frame. And by now you know exactly what those algo HFT charts are. And I will pull this out. Let's say on Goldman Sachs. Bear with me. I got it bigger the other day. How do you get this bigger? Hold on. The way of doing it. There you go. I just double clicked it. So look at the chart of Goldman Sachs, for example, right? So this is done on that quad algo HFT bar chart platform, phenomenal platform. Anyone interested? I keep on repeating. I'll send you all the info. You can do the free trial with them. And it costs about 120 bucks a month. I pay a heck of a lot more because I have a much more broader platform. You cannot trade through them, but you can use them for every other service on anything you need to know about the market, earnings analysis, analyst opinions. It's a very full service platform, primarily used by Wall Street firms and hedge funds. So look at the slow stochastics. That's the S stock. It's not rocket science. When the S stock is oversold, like it's here, how do I get this off here? Well, that's what I put. That's my tweet, right? So anyway, you can see that it's starting to come off the bottom. I even put markers on it most of the time. That's a tactical buy. The fast stochastic is just a STOC, STOC 903. This is the slow stochastics 1433. Well, guess what? When the slow stochastics is oversold, that means it's on the way to get overbought. What does overbought mean? Add the numbers. I already put it up there. 224, it can get overbought at 227 right there. The buy was at this level. Corey, I give him full credit, keeps a very close eye on Goldman Sachs. A lot of times he reminds me on it, right, Corey? So yes, the bottom line is this is great. Is this chart a fantastic chart? No, it's a tactical chart. Do I think Goldman's going to go back to 236? I have no friggin' clue, to be honest with you, because right now a bear will say, and this is important, this is called cognitive bias, whether the glass is half full or half empty. Bears are always looking for some cataclysmic apocalypse of massive drops in the market. Okay, North Korea is going to nuke us, Trump is going to get impeached, all the garbage. Okay, so that's what they're shooting for. I'm just looking at patterns, and I'm not that kind of a bear anyway. If I was that, I wouldn't get out of bed every morning. So bottom line is that you got the bears will say this is a head, this is the left shoulder, this is the right shoulder. Right shoulder means that it will hit this red line, which is the 50-day moving average, or in this case, 50 SMA. It's an hourly chart, which is 229. Well, yeah, you can do that, and then fall. In which case, it is a confirmed head and shoulder. What does a confirmed head and shoulder mean? That Goldman's going to disappear? No, this line here is your neckline, right? That's what a head and shoulder looks like. It looks like somebody flipping you a birdie, and then there's your neckline. If it falls below the neckline, then it falls to the next predetermined level. All structured. Nothing is random in the markets anymore, guys. It's all structured by the machines. They know the patterns. That's what I basically show you guys before the patterns happen. So if it goes here and falls, that's a head and shoulder. A head and shoulder is bad. Head, shoulder. What's good is the reverse head and shoulder, which is basically the big head. Like, oh, this is reverse head and shoulder. Head, right? And then it goes. Here's your neckline. Once it broke the neckline, you got a nice fat move. If you waited around for that long, well, you know, you just gave up a lot of money, because this is a inverse head and shoulder. A lot of the times I write it, but I can't keep on giving people, you know, like a live tutorial. My job, if you notice on my charts, there's so much information. I even write a lot of stuff there, right, during the day. Look at alerts you get from other services, and many of you have other trial services. Do they really explain that much? I mean, tell me the truth. Do they really explain to you what the reasoning is behind that particular alert as much as I do on an ongoing basis? I'm serious. I'm asking a question.
No,
I mean,
nobody does like you do.
Like, not to the degree I do. Now, sometimes I don't want to do it, but I'm so used to doing it, I do it. So, but I even put the pattern in place. Like, okay, that's an inverse head and shoulder, or it's a cup and handle. I mean, God, somebody who has any passion can just learn the whole frigging trading business just by looking at my tweets. They don't need to hear my ugly voice. They can just look at the charts and read the comments, and they can self-teach themselves. So bottom line is, I don't want people's appreciation. I want people to benefit from it. So thanking me and all that stuff is useless. Telling me that, hey, you know your thing. Yeah, it's nice to hear, but so what? That's not going to change your P&L or mine. So focus on this. Use your energies to focus on amazing stuff that I'm showing you guys before it happens. And stop being sheep. Because that is the fundamental flaw of every retail trader. Be the lion. It takes a lot of work, but it's not rocket science. Stop blaming the world for things. Stop being so scared that at pivotal inflection points, you are putting the least amount of money, and as the stock is moving higher, this is what retail traders do. They put the most amount of money, and guess what happens? Stock goes up a little bit and then drops, because that's what the charts are showing. That's why I even put big fat red arrows. Well, guess what? They deserve it, because most of the money should have been put in this range when the stock is breaking out and coming off the low stochastics. But no, what do retail traders do? And every one of you have been guilty of that. They will look at the price, because price is exciting. Excuse my French, very sexy to see higher prices. Well, the algos know where you find something sexy on a price, and they'll hit you there. That's the reason why there's a gap fill here, and they'll hit you hard here. So by the time it's approaching that level, that's the point of maximum excitement. Well, why shouldn't the point of maximum excitement be when I'm showing the deep, deep oversold condition on all fronts? I'm not saying you have to buy the exact low, but when the turns are coming, the candles are forming, just like every single time. The maximum excitement, and this is very hard. Got to really change your mindset. That's what's called mental calibration. Your point of maximum excitement, regardless of what hurt and pain you took on some other losses, other trades, you can make all that back up in 1, 2, 3 trades. That is the God honest truth. Making stupid excuses and feeling all, I call them bunkerized, and going back in the bunker, not buying major tactical lows. I don't know whether the market's at a major tactical low yet. I've explained to you the scenario, but it looks pretty likely, especially with monthly options expiration looming on Friday. I hope we get one other double dip, to be honest with you. I would love that. That would be perfect. But that would be the gap fill, as I explained to you. Or maybe a slippage to 2400. I don't want that, actually. That's a 240-point drop. We need to be out of all positions and short. If that happens, then I'll certainly do my best to alert you guys on that. But aside from that, the point of maximum excitement instead of point of maximum silence should be here. The point of maximum silence for retail traders in the chat room, and I know when it's like that, is here. All these junctures, which are the point of maximum buys. point of maximum excitement generally tends to come around here. Wrong, wrong, wrong. Because prices are very sexy, very cool, very high, and you made some money, except maybe you bought it, put too much in at the last moment, and you're up. You're not watching the chart. Bang, they come and take it away from you. Simple point here, guys. That famous old saying from the old man, the wise old man, Warren Buffett, right? Buy when people are fearful and sell when they're happy. When, well, that's too simplistic. You got to buy tactical levels based on tactical charts. But generally at these points, there's not a peep out of most people, most traders, including my favorite Crusade members. But they're all hiding in the bunkers. Great. And as it's moving higher, that's when they start getting in, which is fine. Technically, if this breaks out, that's a very positive thing. But putting in money at the higher levels as it's approaching some critical junctures, exemplified by big fat red arrows, is the stupidest thing in the world. Last thing I'll say is point of excitement. I really would love to see it one day, is where everybody's really like in there, like saying, I'm buying this, when they are seeing tactical lows. And I've gone through enough of this to know. And I hope that day comes. That's when I've really done my job well, guys. But I can't change personality. Anyway, so let me take this out. So we have covered that. Last chart that I'll show you. This is Tesla's chart, okay? What more can I say? You guys got to read this on your own. This is a beautiful chart. Here's a bull flag, consolidation channel. If it breaks below that, it's going to fall down. It's going to fall to the top of this range. What's the top of that range, which was a screaming buy? Because that was the gap fill, was 343. This was the earnings move. That wasn't a guarantee, but the stock had fallen so hard, there was going to be a bounce, earnings or no earnings. Unless the earnings were so terrible and Elon Musk basically lost his head and said he was going to spend $900 zillion sending everybody to the moon and Mars, in which case the stock would be down here right now. That's not the case. The internals were showing we were deep, deep, deep oversold. Tesla, if this chart pattern continues, is going to go higher. Now, 3, 4, 5 point moves on Tesla during the day means nothing. Nothing. It's a heavily shorted stock. Why do you think it's green? For the last 3 days, including Thursday before the market dropped, Tesla could have been bought, which I alerted, and traded for 6, 7, 8 points within the first 40 minutes. Yes or no? I don't need answers. It's a yes. Okay? Could have bought a call, sold it double. Well, not double, maybe 60%, 70%. So if Tesla holds and this consolidation channel goes, Tesla has major resistance. That's why this big fat blue line at 373 blows above 373 and creates this pattern. It is going to make a new high at close to $400. If it breaks below this and falls into the gap, it's all there for everyone to see. 334. Minor movements in Tesla, back and forth, 3-4 points, happen in 1 second. Yes or no? I'm not going to wait for the answer. Yes. It means nothing. You got to focus on this frigging chart. What is the stochastic telling you? The stochastics are telling you that this is a good buy at this level. Even though, let me change this. Even though, and I highlight this example because this is such a powerful stock. So even though it might just kind of muddle out at the bottom. In other words, the stock could keep on doing this. Does it mean anything? No. As long as it's down here, it's a buying opportunity. The minute it starts to shoot up, like it did here, like it did here, like it did so many times before, and this is the fast stochastics, the stock jumps $5, $6, $7, and boom. You cannot trade Tesla just on price. You have to literally print this chart, put it on your screen, replicate it on investing.com. This is a free service. And that's how you win in that. I cannot be more helpful and forceful in telling you guys, cannot trade these type of high beta stocks by looking at the prices. Please help yourself. Not me. Help yourself. Let me just go over this very quickly and I'm going to round it off. This is an extremely, extremely huge amounts of positive information that I'm giving you guys. This is the S&P 500 swing 533 chart. We are getting deep oversold, gentlemen. Deep oversold. We don't have the turn yet. Generally speaking, on the SPX 533, the best times to buy is when you see the stochastic turn. Not like the McClellan oscillate, and not like the stochastics on the S&P that I showed you, where you can buy like a day or two early. Whichever the case, once this turns, it's a swing buy. You can stick with the trade. We are deep oversold. It is, last time we were like this was back at the end of June. Every single time the market rallied hard. You can see that. This is S&P 500 in the form of candles. The market rallied hard. Look. And the turn here, it was a little bit mixed. The market rallied and then it pulled back. But this stochastic kept on creeping higher. That's known as a positive divergence. As the market remained volatile, the internals were suggesting higher. What does that mean in simple English? In simple English, it means the real smart money, and there is real smart money out there, okay, kept on buying the tactical lows. That's why the stochastics kept on moving higher. The MACD started to keep on turning, even though prices kept on fluctuating. Retail traders are a victim of price watching. It's like crack. They're addicted to watching just prices, which is fine. We all have to watch prices. But to trade off just watching the prices is like crack cocaine, which starts off with something whatever. I don't know, never done it, don't care about it, okay? But once it gets into your system of being an idiotic price watcher all the time and trading off that and getting excited when something's up $6, $7, $8, which is fine, that's momentum. But looking at the charts alongside it is what makes you a real trader or a more smart trader. So this one hasn't turned yet. Real simple, walk you guys through it. I see the RSI turning, which is real nice because we got deep oversold. Anytime you're in this zone below 30, and we went as low as below 10, like it, that's good. Once this turns, you can buy hands down, and as long as we continue with the turn, you can buy any type of tactical intraday volatility. Nothing is confirmed yet. There is a black doji here. I'm not going to get into that right now. That signifies there might be a little bit more to go. This, by the way, down here, when it gets down to -6, is a screaming buy. We're not there yet. All this correlates what I told you before about the possible slippage that might, a little bit of a slippage that might come over the next, whatever, if it fills the gap. If you start to see this turn, and I'll show this almost every day, because this updates during the day, you cannot replicate this chart. Don't ask me why. It's a proprietary chart that was sent to me by a friend of mine years and years ago. You cannot replicate it. People have tried to put in the same parameters and it doesn't work. So unless unless there's an exact link that's sent, I don't know. So this is once this turns, that's a go. This is okay. This looks like it might have another leg lower on the MACDs. So we're not fully confirmed on this yet. But let's see. I'll be watching. If this starts to turn, it'll force this one to move higher. You stick with the swing trade on the S&P 500 and overall markets. Can happen. NYMO. This is the killer. I love this chart. Okay, this is the New York Stock Exchange McClellan oscillator. Markets got so freaked out over the VIX jumping 44%, over Gunlack talking his book. Markets are very manipulative. Like somebody here said, in one of the ACS sessions, wow, that's illegal. I said, yeah, the whole market is manipulated. Life is manipulated. Wake up. Stop thinking everything's fair game. It's not fair game. That's why tactical charts and my type of system that I follow cuts out this fairness part. This is not a la-la land move. Markets are very manipulated. Look who they brought on to talk down the markets on those 2 days. Howard Marks, a hedge fund manager who is basically a very smart guy, but don't tell me that he's got the best track record. Okay? Talking about the market being at an inflection point of a massive drop. Jeff Gunlack, who is very smart, but he's a bond guy. And he only said the market will be down 3%. VIX might go to 20, but he said that might happen in September. Listen carefully. Guess what? They freaked out on that. They used them as tools to push the market down. And CNBC brought them repeatedly. That's psychological manipulation. Retail traders looked at it and said, oh my God, John Lett said it's going to go to 20. Fix frigging jumped to almost 17 and a half. So most of his move is over, right? No, it might go higher. But look how the market manipulates people. They bring in all these people to talk trash because they are making money on their books. Look, Jeff Gundlach doesn't care if you can't pay your bills, if you lost money. Howard Marks cares now. They made a crap load of money on this quick 4-hour type of drops. And Gundlach's been talking down the market for months while it's making new highs. And he acts like he's a big-time stock analyst. No, he's a bond guy. He's very smart. His bond fund, superior returns. But they trash talk the market down. Who do they bring the other time? They bring Dr. Faber, doom and gloom. And his heavy German accent. You know what he does, right? Only during bad days in the market. I hope you guys learn. But you guys are smart people. I'm sure you know what I'm talking about. This is exciting. Why? Very simple. If we go back to, and I'm going to go back a little bit more, this chart showed we were as oversold as we were during the elections, in which case the market was way down, right? So saying all that, let me just go here and increase the number of months. Let me make it 10 months. Bingo. November. I hit it. November, we were down to we were down. This should show the price labels. Hold on. I didn't do that. Is everyone following me so far? Am I going too fast for you guys? Because I'm showing you some real important stuff, guys.
Yeah,
Perfect.
I'm with you, Frank.
Huh? Frank, you know what's perfect. You know, also when you hit that zoom thumbnail and you'll catch the right corner where the show.
I know, but I'm not worried about the right corner. I'm showing you the real picture of what will happen. I know exactly what you're saying. It comes over, it highlights this part. That highlighting is not going to make you money, Corey. What's going to make you money to see previous instances where the New York Stock Exchange McClellan Oscillator hit this deep down abysmal levels and the market bounced like nobody's business. That's the reason why I didn't highlight the bucks. Okay, minus 75. Trump's going to win. The world's going to fall apart. It's going to be the worst thing for America. Blah, 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 blah. Right? That's all we heard, right? Market's going to fall apart. Markets did fall pretty hard after hours. But then it was like, see you later. But before that, we dropped to minus 75. Minus 75. What did I say many times before in my previous ACS sessions and things? And I know, Corey, you remember. And Exita, whoever was here before, probably remembers. When it gets down towards these levels, you gotta basically put in some money in the market. Forget about 1 or 2 day type of like, okay, it's gonna dip, it's gonna fall the gap. You gotta put something in the market, and if it works out, you are gonna have your best month ever. Period. Minus 75. This is like the height of panic. Now, what really happened in the market for us to drop? We dropped only 200 points from the high, right? Here we were far lower on the S&P 500. Far, far lower. So, what happened that's so scary? Did the credit markets blow up? Did Greece come back to the world markets and say, that's it, we're taking Europe down? Remember, we went through that for years, right? Did, like, what really? I mean, I watched the credit market very closely. And even during the worst drop where the VIX was up 44%, the 10-year government bond yield, which is a good indicator of safe haven buying, was slightly down. That means billions and trillions didn't flow into the government bond market and say, that's it, we're out of the stock market, we're sitting here for the next 6 months. No. So there's a lot of positive divergence going on. Let's stick to this. It's minus 75, minus 88. Well, guess what, where we went to? We went to minus 82. Holy Lord. These are serious crisis levels on the McClellan Oscillator. One or the other. We're either we're going to a full-fledged war, in which case Oscillator will go to frigging minus 200 with Korea, which is going to be the worst thing ever if we get into a firefight with them and then start lobbing nukes, which I know they won't. Okay? So the bottom line is that's a different story. That's a black swan event. We always have to be aware of that, absolutely. But technically speaking, Technically speaking, these levels are screaming buying opportunities. This is the RSI. It's starting to move up already. But this generally, when it gets this deep, just look at the previous patterns. Let's say you know nothing about the market. Do you know that most algo HFT programmers, very smart Americans, very smart Chinese, very smart Indians, those are the three, and very smart Russians. Those are the four groups which basically write algo programs. All right? Because they understand math better than anyone else in the world. Very smart, homegrown guys, Russians, Chinese, and Indians. Not Koreans, not Brazilians, not Colombians, not partying Cubans in Miami. Nothing wrong about Cubans. I have a lot of Cuban friends. No Colombians, no Venezuelans. Just these four groups. They are the smartest when it comes to anything. All right? So the bottom line is they don't know much about the market. They're just looking at these numbers and patterns, inputting them in their variables, and boom, the programs go into effect. So generally speaking, real simple terms, once it gets down here, generally it's a screaming buying opportunity. Will it be different this time? It can be. If there is a full-scale nuclear war, you don't need to trade. You don't need to short. You can short. Look, I'm a survivor of 9/11. Now, why do I say that? Because I'm some sort of proud warrior? No. I was just an idiot who worked on Wall Street and almost got blown out of the water that day, of the building. And what can I say? But I'll tell you one thing. Markets shut down for a week, opened up, rallied, never looked back. When I ask people, when was the real low in the market prior to 2009? Can anyone answer me? Was it 9/11, 2001, or was it? Everyone says, "Oh yeah, it was right after 9/11." No. Does anyone just take a guess when the real low on the Dow Jones Industrial Average was? It wasn't September 11th. Go ahead.
It was in March. It was in March, like 8th or 9th.
Like for the next year, 2002.
Yep.
And
exactly.
and does anyone remember the reason why? There was a credit crisis, big time. And what was it propagated by?
Mortgages.
Nope. That was way down the line, man. You live in America? Come on, man. It was because of Enron. Okay? Because of Enron. Because Enron blew up. All the fraud and all that stuff. The markets hit a low in the middle of 2002. Okay? The mortgage stuff didn't come till 2007, 2009. All right? That's when all of you got super excited about buying property and flipping them. Like a bit of it is happening right now. The difference is that this time the credit markets are in much stronger strength. Banks are much more capitalized. This was your mortgage crisis. Watch The Big Short. Okay? 2002 was Enron. Remember Enron? Guys, don't remember Enron? Well, do you know what Enron was? It was the largest commodity dealing and futures dealing commodity firm for natural gas and oil. And Enron blew up. When you have a blow up in the credit markets, and please look at them. These are very important for all of you. Okay? Not because of history or looking smart. Enron caused the market to drop down. And correctly, the mortgage crisis when the credit market blew up is what caused this amazing mini depression in 2009. The crisis, which is still getting built up. And built up meaning recovery, believe it or not. Okay? So these are like really abysmal levels of selling. So I don't know. We're getting there. I think we're not quite there, but if we keep on waiting for that perfect moment, we are not going to catch it. But knowing what I put out there, you guys will catch it. So if you're not really didn't do anything on Thursday and Friday, fine, no problem. Get ready to hopefully we get a second tactical dip, whether it's the gap fill or whether it's a little slippage. Get ready, guys, because when this starts to turn, I repeat again, it's the last thing, just take away from me. If you just keep on watching prices, you will not hold your swing trade. You will not make that return that you deserve. How about that? The return that you deserve. Instead of making the same old excuse, I sold too early, I sold too early, I sold too early. Okay? You don't have to sell at the top. You don't have to buy at the bottom. You have to get the meat in the middle. And that for those, you have to rely on my charts. On that note, guys, I gotta go. Have a great evening. I'm gonna put this up on the YouTube channel. And God bless you all. Thank you so much for everyone attending. And start and of course it's going to be a very, very important week. And I'm sure that I will do my best to help all of you. The question is, are you guys ready to help yourself? Have a great